We're not done with Greece, are we?
No, not really. And we have the Club Med meeting as well coming up. So presumably Tsipras will be hoping to get more support for his calls for less fiscal stimulus, for less fiscal austerity, potentially even debt reduction and all that. And given the overall climate in Europe at the moment, still fairly weak growth, there may be some support. And that's a concerning news for the Germans in particular. So
yeah. Let's talk about Draghi yesterday. Let's talk about central banking. Central banking, I think, has been quite dull for quite a long time. It's now getting quite interesting.
Yep.
We were discussing this earlier on in the programme. How do you engineer a steeper yield curve, and is that what central banks are now thinking about?
Well, it seems that that's the latest, if you wish. If you look at the Kuroda speech earlier in the week, but also what Draghi kind of alluded to during the press conference, it is a big worry for them, the fact that bond yield curves have flattened so much in the Eurozone, in Japan, and as a result, the banks are struggling to generate profits. By implication, that's really hampering the lending channel.
Are you saying they didn't want that to happen?
Well, I mean, in Kuroda's words, they were surprised but how significant the negative impact on long-term yields has been, right? So they were, I would say, not really expecting that. And if anything, we do think that the BOJ in September, potentially the ECB in December, will take steps to engineer a re-steepening in the curve in a way to support the banking sector in their economies. And to do that, we think that they will reallocate some of the purchases they are doing at the moment from the long end of the curve to the short end of the curve. In the case of the ECB, that may mean that they need to really scrap the floor implied by the deposit rate at the moment. And why is that important? It is important because it will help the banks. The banks need spread. They need the steeper curve. In terms of currency impact, however, it is somewhat more nuanced, if you wish, a more complex impact. If indeed we do see the short end of the curve coming under renewed pressure, both in Japan and the Eurozone, that will be the tantamount to a rate cut, if you wish. Both euro, both yen should weaken on the back of that. However, different from a rate cut, the long end of the curve could actually may well continue to move higher. And in the current environment, we have the Fed moving closer to hiking rates, which is negative for bonds. We have central banks like the ECB, the BOJ, the providers of the puts for the market actually telling you, you know what, we're going to leave the long end for the time being on its own. That could actually mean that long-term yields across the board could start creeping back up. And that, I think, it will have the impact of a tightening in global financial conditions, which is a worrying news for commodity currencies, for risk-correlated currencies. I think in terms of impact on euro and yen as such, the immediate impact, negative because of the lower short end of the curve. But longer term, you think that if I'm a European investor and I've been selling euro to buy high-yielding assets abroad, and all of a sudden my long-term yields at home are not necessarily looking as unattractive as before, maybe I'll think twice. So not necessarily as negative for euro and yen as, say, it will be for commodity currencies like Aussie, Kiwi, high-yielding currencies really benefiting from the latest risk rally.
Valentin, it looks as though it's already happening, though. Can he not have just moved the market with words? Already we have hints in Japan that maybe they're rethinking where they're going to be buying. And the 30-year curve, we've already seen the 30-year sell-off. We're already seeing it happening in Germany. On my screen at the moment, we did see a steepening in the curve once again. We are seeing that 30 and 10-year, the 10-year, 30-year reversing that bull flattening trend. And we rose up just on words from Draghi. Meanwhile, he's saying he doesn't care at all about the hit on banking profitability.
I think that Draghi's comment should be interpreted as effectively highlighting that the ECB is not ready yet to really consider additional options. But I think those changes in the QE modalities are coming, and if anything, our call is for such changes to be introduced as soon as December. If, in the meantime, that those verbal indications, both from Draghi and Kuroda, do work, and we do see that desired re-steepening of the curve taking shape, well, talk is cheap, right? Why should the ECB be wasting any resources really to engineer something that's already taking place? I do believe, however, that in the current environment, investors may want to call the central bank's bluff yet again. So unless Draghi or indeed the ECB does deliver, that renewed steepening we are seeing at the moment may not be sustained. So the ECB may well have to take some action in December. The bigger picture here, however, is that, if anything, we may have reached a limit in terms of how far further the long-term yields may have could fall from here. So from that point of view, the risk now 3-6 months out could be higher longer-term yields and presumably tighter global financial conditions.
Valentin, therefore, can you cut through some of the mist that is building at the moment? Are you on the side that Draghi didn't move because he doesn't need to, because volatility isn't there and he's waiting for more volatility coming later, powder dry argument? Or on the flip side, is there just nothing more he can do? Is there too much turmoil within the ECB that they can't agree in which way to pull?
We believe that the ECB is still able to deliver, and indeed the measures we expect in December could indeed have an impact and indeed prolong their asset purchases program, allow them to continue expanding their balance sheet fairly smoothly. That said, the bigger the overriding message clearly is, and as you've highlighted, both the ECB and the BOJ are clearly moving very close to the limit of their ability to stimulate growth. So monetary stimulus may have to be supplemented by additional fiscal stimulus, if you wish, in the case of the Eurozone, to really get us where we want. But we are not there yet. I think that's a topic for next year, where investors will be openly questioning ECB's ability to deliver more. But for the time being, next 3-6 months, the ECB is not out of options yet.
Talk to me about whether September is alive or dead, because the market yesterday suddenly got very excited about this Brainard speech. She's a massive dove. If you wanted to communicate that September was a live meeting, she is the perfect person. She's put that speech in very late, just before the blackout period. Am I reading too much into this?
Well, I think I got a few questions myself earlier today about that. Yeah, that's the interpretation, that indeed that the Fed wants to communicate that potentially investors are wrong, really dismissing September for the time being. What's also quite telling is the fact that, well, the US data was not great, right? Not necessarily supporting the case for a rate hike, yet Fed speaker after Fed speaker were kind of certainly highlighting that they're fairly dismissive of the latest data, and they do want to normalize rates. So it's a bit of a decoupling between the data and the supposedly data-dependent monetary policy in the US. So I think that in percentage terms, you mentioned the word function previously, I think the investors may be a bit complacent going to the Fed meeting. Our call is for the Fed to stay put for now. No hike in September. We expect the next hike to come only in December. Chances are, however, that the statement, the press conference, the message that will be communicated presumably could be more hawkish than the markets are expecting at the moment. In other words, they could phrase it in a way, okay, we have that big risk, which is the US presidential elections, but if things do not deteriorate significantly before or after, we may be well on course to normalize rates before long. I think that in itself could be sufficient to lift short-term rate expectations. Clearly, December attracting most of the attention and could support the dollar. And again, given that all that is happening in an environment where, like the likes of the BOJ, the ECB are clearly reaching the limit of their ability to ease further, and ultimately that could translate into a higher long-term yields, could translate into tighter global financial conditions. So you think that the dollar could do well, but I think the biggest losers need not be euro and yen. That could be the risk-correlated currencies.
We live in interesting times. Suddenly it's all got exciting again. Valentin, always a pleasure to see you. Thank you very much indeed for taking the time. Credit Agricole's head of G10 FX Research, Valentin Marinov.